And welcome out to our halftime report presented by tackletrading.com. I actually really like that music, Matt. Get you right in the mood each and every morning. Matt, how you doing this morning?
Doing good. Doing better than gold.
Gold is down. The market's down. Gold is down. The dollar is up. Everything's going basically based on that theme right now. And a lot of that dollar strength is due to what's happening internationally, Matt, with Trump and all politics and that. I read an article I read every day, in terms of the morning report over at briefing.com. I read that page one article. I've been doing it for a decade. And they used a phrase in there that kind of grabbed me. They called it a controlled burn. Okay. Mm-hmm. The S&P 500 is down 13 points, 0.46%. Do you agree with briefing.com that it's a controlled burn, that the market is just pulling back naturally?
Well, if you're looking at the S&P 500, yeah, I don't see anything to be too overtly concerned about. I mean, we're down 0.5% on the day so far. Nothing to get too overtly upset. I mean, the NASDAQ still looks really, really good on the NASDAQ, kind of holding its resistance level on the NASDAQ. Let me hurry and look at the NQ contract. So the NASDAQ's down literally basically nothing, down 10 points on the day. That's basically break even, crude down a little bit, gold down. So in terms of the stock market, I wouldn't call it a controlled burn, just a normal little pullback, nothing to be too concerned about. But, if you're talking about that controlled burn from a currency perspective or emerging market perspective, I mean, my God, no, there's nothing controlled about what's going on in the emerging markets from a stock perspective. There's nothing controlled from a currency perspective. Euro getting trust, emerging market currencies getting trust, emerging market stock markets getting absolutely crushed. They're all in bear market territory. Turkey's market's down 56%, Brazil 29, Argentina 26, China 22, Russia 20. So there's nothing controlled about what's happening in the global markets.
NQ here sitting at a high point, still showing some relative strength. It's only down 0.11. We'll take a look at the heat map here in a minute. RTY down 12, the S&P down 12, now actually coming back. Go to an intraday chart on ES. I was looking at this before we started our show, obviously watching the intraday market. Now, Russell's selling off. But this morning, Matt, the market looked like it wanted to rally, and in fact, we came out from overnight action at 6:30 in the morning, our time, which is when the futures market opens. The market took off to the upside. And then at 7:30, when the market bell, ding, 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 it opens, the market continued to take off to the upside. Then we saw some aggressive selling here from 28.45 down to 28.23. Now, that's about a 1% intraday move. If that broke support, do you think this could get to the point where we are burning in this market?
I personally do not think so. And the reason I say that is this market has still been very, we've said it all last week. We've said it for months now. This market has been very resilient to international conflict and international risk, the geopolitical risk that we've talked about in the past, what's happening in Turkey last week coming into this week. Tim, I mean, we're still only down relatively off the highs from last week. We're only down about 40 points, which is about less than a 2% movement off the highs. So I'm not taking this as a massive risk. Could it turn into something a little bigger? Could we see something dramatically sell off like we're seeing in the international and the emerging markets? Maybe, but those international markets have shown weakness before the lira exploded last week. They've been weak all year. So I don't see that the U.S. markets are going to start showing the flight to safety that we're seeing in the international markets. U.S. markets have been a safe haven this year, and I see them continuing to be a safe haven until we start seeing major support levels get broke. We have not broken any major support levels. We haven't broken any minor support levels. We haven't broken any support in any capacity. You're still above your previous support levels at 2,800, currently at 2824. The selling from an intraday perspective, certainly a little concerning, but Tim, it's currently at 28.24. The lows on the weekend were all the way down here about 3 points underneath the current value. So if it does break 28.20, you could certainly see 2800 in the target here. But I would still be looking to be a buyer at 2800.
My personal approach right now, and I mean, I think that's the most important thing. You talk about your opinion all day long, but put your money where your mouth is. I'm carrying positive delta. Okay. Even though I see the risk and I'm aware of everything that's going on, I continue to carry positive delta, which means I have mostly long net bullish positions, but I'm hedging that. I have, puts on gold. I have other different positions out there. I have puts on different products. I have controlled puts on some of my covered calls. Just depends. I'm taking it on a case by case basis, but cautiously bullish is where my opinion has been for a couple of months. It's not changed. And, here this morning, I think sometimes we can get caught up and swept up in the intraday action of the day to day, and we can forget to look at the big picture of how you're supposed to be building market posture and your overall approach to the market, right?
Well, big picture, earnings were fantastic coming out of earnings season this quarter. Economically, we're still plodding along, doing fairly well from an economic perspective. The market trend is still bullish, so economically we're still bullish. The trend is still bullish. We're seeing a lot of the biggest price movements are again from an international perspective and things that do trade internationally, like gold, oil, and some of those things. But even at gold, Tim, obviously gold getting absolutely beat up today. Looking at the GC contract here, you see gold's just breaking down from an intraday perspective, but it's also breaking down from a daily perspective. We talked last week about how gold has kind of lost its safe haven status in the U.S., but again, that's just the U.S. And yes, gold is priced in dollars from an international perspective. But Tim, if you're sitting in Turkey and your currency is devalued by 50% against the dollar, gold has actually skyrocketed if it's priced in the Turkish lira. So, gold from an international perspective, if you're sitting in Russia and you're holding the Russian ruble, or you're sitting in China and you're holding the Chinese yuan, or if you're sitting in Europe and you're holding the euro, or like we said, the lira, or the South African rand, or the Mexican pesos, or any of the pesos around the world, if you're owning those currencies and you're seeing those currencies get crushed, gold is still a safe haven from an international emerging market perspective. It's just in the U.S. where gold has kind of lost that safe haven status. So I still see gold as a safe haven against currency, and I always will see gold as a safe haven against currency. But it certainly has lost a little bit of that belief in the U.S.
If I'm in Turkey and I got a pile of gold, I feel better than if I have a pile of lira. I can tell you that. It's not a debate, right?
Any currency around the world, not U.S. dollars. So if you're in any other country,
sure,
owning any other currency, you want to own gold right now over the currency. And so when we're looking at here from a U.S., sometimes we can lose that perspective. But gold is absolutely a safe haven against currency, even if it is coming down here today.
Cody, I'm trying to find a tryptophan joke here. What's that chemical in Turkey that makes you sleepy? And tying it into the currency. I can't find it. I'm not a comedian, so I have a hard time making those connections, Matt. But see if you can come up with a tryptophan joke, Cody, and put it on another meme. I love the meme that he put together. Did you see that, Matt?
Yeah, time is a flat circle, but gold always holds its value. With Can
you bring that up in front of you right here? Is there
any prep Cody sent us today?
Oh my God.
Yeah, made us laugh. That was a good one.
I love it. You got to have fun with this kind of stuff. Gold is breaking down. Obviously, the markets are breaking down in the metals markets. Take a look at silver while we're on the metals discussion here, and let's just take a peek at what's going on with that. In my opinion, and I talked about this in the commodity report over the weekend, and it was at the very end of the video I was doing, Matt, about a 20-minute video for our pro members. And I was talking about every different commodity and how I'm playing them and some ideas on what to do with them: crude oil, natural gas, gold. And I got to silver, and I essentially said this: guys, I know silver's bearish. I just don't want to short it in my account, because if I want to play metals down, I'm going to play gold down. If I want to play silver, I'm probably looking to go down to the coin shop and buy physical. I don't know what it is. Maybe that's an emotional thing, Matt, but I just don't see as much opportunity shorting silver as I did gold. But here we are. Big red candle. You could have made some money on it. I passed on that trade because I just did not want to play it that way. I don't know. What's your take?
Well, I mean, pick your poison. They're both going to do very similar things. If you expect a bigger movement in gold versus silver, I think silver will always move a little bit more from a percentage perspective. Silver has been weaker than gold from a trend perspective. I could see either one, but they're both going to be very, very similar charts. But when I ever see things like this break down pretty dramatically, like we're seeing in the silver and the gold market today, and the commodity market in general, I always try to look at, okay, where historically is those major support levels? And if you're looking at it from from a commodity perspective, looking at a few years here, I'm just going to go back a few years, looking at it from a commodity perspective, you don't really have a lot of support here, but you do have a little bit of support at 15. It was old support over here. It was old support all the way back here in 2014, early 2015. So there was a minor level of support there at 15, but your real support doesn't kind of come down until about this 14 level. So I think you could have a fairly accurate expectation for silver to keep coming down into this 14 level. Versus on the gold, on gold, when you're looking at it from a historical perspective, gold doesn't have any major support. Obviously, we've talked about the 1200 level of support. That's kind of where it is. Underneath 1200, you're not talking until it gets down here into the 1130 level. And if gold breaks 1200, you might see silver at 14 and gold coming down to the 1130 level fairly aggressively.
You know, the way that I trade any one position is always very small relative to my overall portfolio. But I'll tell you, I have puts on gold, on GLD, and I'm not taking profits on them at 1200, right?
Oh, you're saying, I absolutely understand that. I mean, 1200 is a target. It's a major support level. But if you look at this from an intraday perspective, as it is approaching that 1200 level, Tim, you're still seeing intraday pressure coming down into 1200. I'm not seeing that slow down in any capacity at 1200. So I don't see any reason to take off those puts on gold until we start to see it slow down. And we're just not seeing that right now.
Yeah. And for me personally, it comes down to portfolio design, also execution, strategy, and all that kind of stuff. If you're emotionally taking profits because you need to hurry and lock in a win, there might be something going on with your overall equity curve, or your overall approach to markets. Trade your plan, execute your plan without emotion. I'm with you, Matt. I like this potential continuing to go down. Now, if it showed me something as a reaction off of this and a strong rally and I ended up giving back my profit, I'm comfortable with that. I don't want to miss out on the trend. And the most important thing I've learned in 13 years of trading is trade on strength, right? Mm-hmm. Trade on something that's working and get out of things that are not working, get away from problems and work towards things that are actually successful.
You truly do want, if you take away anything from this conversation, Tim, you want to buy into strength and you want to sell into weakness. Yep. You don't want to be the trader who tries to cherry pick the bottom of any marketplace, whether it's the stock market or the commodity market or the currency market. You don't buy into weakness, you sell into weakness. And that's exactly what we're seeing in the commodity market right now. We're seeing tremendous weakness across the board, not just with the precious metals. And again, I can't say it enough. Gold is still a safe haven from a physical perspective. We're seeing that around the world. But from a paper perspective, this is showing tremendous weakness, and I expect that to continue.
Yeah, and let's just make sure. I'm just seeing this chat here with Cody. Are we still good live, Cody? Are we good to go? Because I'm seeing your screen good, Matt. All right, very good. Okay, and by the way, if we are live and you're out there with my halftime crew, we're calling them the halftime crew now, Matt. I like the name. And you're here with us, say hello. First of all, good morning. And give us a quick like and share so that we can get the word out and kind of talk markets here. Crude oil with the rest of the commodities market is obviously coming down as well. Crude oil down 2.45%, Matt, and breaking a very key support level. On the weekly chart, we still have a long-term uptrend. On the daily chart, we have short-term weakness. Obviously going to be a relative move against the dollar. But what's interesting about crude is we've not always said that. The dollar's rallied and crude didn't always sell off. And so if we're going to attribute it to that today, is that something unique based on the current move, or are we going back to the old playbook?
No, I don't think one day it's going back to the old playbook. The dollar's actually fair. It's up 5 cents on the day, Tim, but it's really kind of flat on the day. And it's had this big green candle I'm not too concerned about. That was overnight when the currency market actually opened up last night. Quickly went down, quickly recovered. It's basically flat on the day. So I'm not taking today's price movement in crude as anything coming back to the divergent behavior between crude and the dollar historically, because both these trends, overall, primary uptrends in both gold and crude, are still there. I'm just taking this as tremendous weakness across the board in the commodity market.
Yeah. Yeah. And that's where intermarket analysis comes in. And really, that's going to be the theme of our conversation here today, Matt. When one market moves, the other markets move, right? And one market is going to affect the others. The major capital markets out there, you have commodities, okay, which we've been going over: gold, crude oil, natural gas, all those types of things. You have currencies, which the dollar is the number one currency in the world. You have equities, okay? And then you also have debt. Now, the debt market is going to be your bond market, and all of the conversation, if you've been reading the news recently, and put in, the 10-year treasury note or something like that, Matt. And that ZN, I believe, is the one you're looking for right there. There's our 10-year. The most quoted and observed bond market in the world is the US Treasury market. And the 10-year is kind of thought of as the benchmark that you're always going to focus on first. When treasuries are moving, obviously that's going to affect interest rates and yields. The treasury market's been bearish for a long time, but now it's starting to go back up. Do you think yields are going to come down in this market? That would be crazy to me.
But that's kind of what you're seeing.
Yeah.
Right. That's kind of what you're seeing with the strong movement in the dollar over the course, especially with the breakout of 95 we saw late last week. Yields are going down right now as it's going up. Yields are kind of going down. So that is a little crazy. But I mean, Jim, we've seen crazier things. Gold losing its safe haven status in the U.S. markets this year. I mean, that's a little more crazier than the yield going up as the dollar's going up.
Sure. And there are ETFs, by the way, that track the treasury market, some that are inverted, some that track with it. I mean, there are ways to play this. So, and let me ask everybody out there, do you expect interest rates in the economy and the market to go up or down over time? Because if you expect them to go up, which most people do, that means this product map most likely will go down.
Yeah,
there might be ways to play that at some point. I don't trade a lot of bonds. In fact, I can't remember the last time I traded a bond, including those ETFs. But
I've said this for a very long time. Bonds are for old money. Trading's for new money. We're traders.
Yeah, 10-year bond ETF. I'm trying to think of what even the symbol is on that. I know we have it on the Tackle 25. Let me look this up real quick.
TLT.
TLT is one of them. I think that's the 20-year, though.
Is that the 20-year?
Mm-hmm. Check out, let me organize this by volume. The 7 to 10-year, you have one on IEF, which is liquid. That's the 7 to 10-year bond ETF. They have a composite of all those different ones in there. That would be one you could trade. See if there are even liquid options on that thing. Because that's the same chart we just looked at, right? You know, if you think about it, same exact chart on the ZN contract going down. So if you believe that interest rates are going to go up, this would go down in price, Matt. Go to the trade tab on this.
Analyzing bonds is almost like analyzing the VIX for me.
This is making you so happy right now. Open up the October contract. Not too bad. I'm looking at 10-cent spreads. I mean, there's no weekly options in there, but I'm looking at a 103, 102, 101, and the volatility is only 5%. You could probably play straight put or call options on this if you are looking for a play. By the way, whenever I have just a random thought, I'm going to go look for liquid products. I found a list of 15 different bonds, but I went for the one that had over 1 million shares a day right away because there's a lot of bond products, because I knew usually the options are more liquid when there's liquidity in the stock, Matt.
Oh, that's a general rule of thumb.
Yeah.
I don't know what you want me to analyze on
a scale of 1 to 10. How likely are you willing?
We're losing viewership every second we keep this chart up.
When the market moves, there's always a relationship. Bonds is one of the bigger markets in the world. It's actually bigger than equities, right? And obviously in the futures market and the ETF market, you can play calls and puts. So
I don't see the bond market as a trading market. It's more of a market you park money in and let it just sit there and die.
Yeah. Well, to sit there and die. I like it. Let's go back to the dollar then. So let me ask you, with that candlestick and with that action that's happening on the dollar, how would you play that? I mean, is there a play in the currency market on that?
Well, definitely. I mean, you got lots of potential plays in the currency market. I don't see the weakness in the emerging markets or even some of the major currencies like the euro subsiding overnight, Tim. This breakout of that 95 level, 95.5 level is significant. And yeah, it's already made a tremendous movement in the first couple of days, but I still believe you have room there to go. I mean, from the emerging market currency perspective, they are all getting crushed right now. And that's, again, not going to stop. You look at some of the, obviously you're not going to play the dollar index. You could with UUP if you wanted with call options. But if you're looking at a straight currency pair type situation, looking at the euro US dollar here, still showing tremendous weakness, still selling off throughout the from an intraday perspective. The only concern you have here with the euro is you are approaching some major support levels coming up fairly quickly. If you look at this just from an overall trend perspective, you do have major support here between 113 and 115. But Tim, if it breaks those levels, you could quickly get down into these levels down here between the 107 and the 105 level, which is a tremendous movement of 600 pips to the downside. Now, obviously, that's not going to happen overnight, and that could be weeks to months as that's going. But this is not a minor break of the euro here at 115. This is a fairly important break at 115. Like I said, you do have support levels all throughout the 110 to 113 level, but I'm seeing this as a major break of the euro versus the US dollar. The British pound versus the US dollar showing tremendous weakness over the course of the last week and a half. It's overextended. I do expect eventually for this to contract back up into resistance, but that would present a major bearish situation. Like I said, when looking at the emerging market currencies like the dollar versus the Turkish dinar, lira, you're still seeing tremendous weakness in the lira versus the dollar. And you can kind of see that with the South African rand. You can see that with the pesos. You can see that with the Russian ruble. You can see the weakness with the Indian rupee. And so these emerging market currencies and some of the major currencies out there are still showing tremendous weakness against the dollar. And if there's one thing that this year has proven, it's that the dollar, whether you agree or disagree with that, whether you see the long-term risk to the dollar as part of this equation, but the number one safe haven in the world right now is the United States dollar, and that is going to increase, in my opinion, not decrease.
Well, I mean, it's obviously playing out that way. And I think that that's a big part of Trump's strategy, quite frankly. I mean, a lot of this saber rattling and everything that's been going on, he's been on Twitter this morning going on a rampage again. It's insane. And you see what's happening.
Yeah, it's a rampage every single day on Twitter.
I get it, but I think that's a part of his strategy. I mean, him pounding his chest and saying, hey, listen, we are going to enforce all these tariffs and these trade negotiations. A big part of that is because he knows that will strengthen the dollar. And then he can shout from the top of the rooftops about how he's out there defending America first again, when really it might just be a short-term move and then end up having a reversion to it as well. I don't know. He might be right, by the way. Maybe it ends up just creating a bull market in the dollar because everybody knows that he is, kind of driving it that way.
Well, yes, I agree with that. But it's kind of like, it's a misdirection to a certain extent. You yell and yell and yell one day, people have a tendency to forget what he was yelling about the next day. And it's just this distraction mechanism. Who knows what who knows what his geopolitical strategy really is, because a strengthening dollar and an international crisis from an emerging perspective is not good for the world economy.
Yeah. Yeah. And it's not good for central bank policy. And
it's not good for the U.S. economy in the long term either. U.S. markets, U.S. dollar might be seen as a safe haven now, but if those emerging markets continue to get crushed, and especially from a currency perspective, Tim, those countries will have less trade with the U.S. over time. You combine that with the tariff discussion, the emerging currency crisis, that is continually to evolve. That's going to be putting a tremendous amount of pressure on blue chip companies to do a lot of trade from an international perspective. So I don't see what's happening right now we're talking safe haven, Tim. I don't see what's happening from an emerging currency crisis perspective as a healthy or a good thing for the U.S. or for the global markets.
There's no question. I'm with you on that. And it's going to play itself out day over day over day. I'll tell you right now, the market is pushing money into the obvious currency here in the dollar. They're also putting it into the yen. I don't know where the weakness is going to come in. I know that the euro is dropping right now, but I was actually more concerned about the pound. We were talking about that a few weeks ago. And maybe it's going to be both. Maybe it's going to be all of the commodity driven currencies, the Aussie, the New Zealand, the Canadian dollar. If commodities are dropping, they're probably going to take it on the chin as well, Matt. Big safe haven currencies are the ones rallying, and even the yen here is up.
The yen relative to any other currency is up. The dollar relative to any other currency is up, and the Swiss franc relative to any other currency is up. And those three currencies are the safe haven currencies. The safe haven for Europe is the Swiss franc. The safe haven for the East is the Japanese yen, and the safe haven for the West is the U.S. dollar. And those currencies are all relatively strong right now. Versus any other currency, they're weak. There's a tremendous opportunity on the buy side from the dollar, the yen, and the franc, and there's tremendous opportunity from the sell side on the euro, the pound, and the emerging market currencies right now.
Yeah, there's a couple other things that obviously I want to talk about here today. One is the VIP's earnings and how to protect it. I want to look at Tesla. I want to look at Spotify as well, Matt, which was a rip-roaring trade that we had on the scouting report. Talk a little bit about that. I have a failed trade on Google I need some help with that maybe you could look at. So we can go any direction you want to go with that. VIPs is most important for our Tackle 25, audience there. The VIPS here is a stock that we put on the list, and I argued very strong for this stock. Right. And basically, when we were going through and we were picking our 25 stocks at the end of last December to be released for the entire year, I said, Matt, we got to get this stock on the list. We went through it. We went through it. We went through it. It started off the year very good, but Matt, it has been a terrible performer for about 6 months. Explain.
It's been cut in half. I mean, it's one of the worst performing stocks on the Tackle 25. I don't regret putting the VIPs on the list because it is a good cash flow stock. Even today, it's still a good cash flow stock. But the VIPs, and we've said this before, but when you're talking about some of these volatile stocks that we like to do cash flow systems on, there's a reason you're getting 4 or 5% in terms of ROI on a covered call on the VIPs. It's because it's tremendously volatile. And unless you have the experience from a management perspective of years, in my opinion, you probably shouldn't look to do covered calls on something that is so volatile if you don't know how to manage it. But if you know how to manage it, you could do a tremendous amount of cash flow on a stock like this. So I don't regret putting it on. Fundamentally, it was a growing stock when we analyzed the fundamentals. It had a fair value. It was a cheaper stock. And what we were looking at when we were creating the list, we were kind of comparing the VIPs against Amazon. Amazon's been a stock that's on the Tackle 25 in the past. But from a fair valuation perspective, PE ratios, PEG ratios, all of that jazz, the VIPs looked a little stronger from a fundamental perspective, from a valuation perspective. And the simple reality is not a lot of people can afford 100 shares of Amazon to do covered calls on. I mean, that's $100,000 position just from
200 now. What are you talking about? $100,000 position. It's a $200,000 position now.
Even on margin, it's still $100,000. I mean, so by no means were we suggesting that the VIPs is a better investment opportunity than Amazon. But when you're looking at it specifically from a covered call perspective, the VIPs was a little easier from a covered call perspective than Amazon was. For the first few months of the year coming into 2018, it had tremendous price movement. It went from $12 up to $19. And, you look like a genius at that point. And now we look, the opposite of being a genius now. But
I mean, that's the thing about markets. You want to feel right, just wait long enough. Eventually, you want to feel wrong. You wait long enough, you'll eventually be wrong too. I mean, that's the nature of markets. You don't get caught up in that part of it. But I'll make a statement here, Matt, that you tell me if you agree with. If you hold a covered call into earnings on VIPs, that's a poor strategy.
Well, again, we talked about it last week, but you basically are limiting your upside potential and you have unlimited downside potential.
That's what I'm saying. So you're going to cap the upside. So in case VIPs had a blowout earnings gapped up to $15, which I don't expect, nowhere near it, you don't get any of that profit. But if it gets killed, then you don't even protect your downside very well. So the covered call alone on earnings is one of the worst strategies, in my personal opinion.
So you're selling the $10 call option, which basically means this. If earnings is blowout earnings and we see tremendous movement to the upside, say it goes to 11, 12, 13, whatever it is, you're still selling that bad boy for $10 basically. So you're limiting your potential to the upside. But then if it gaps down to say $7, you're only covering 30 cents to the downside. That's we call that an inverted reward to risk ratio. And you would never, ever do that, not in any capacity. If you're going to hold a covered call through earnings, the only appropriate way to do that is to also add the insurance to the covered call, which calls that the caller trade. So if you're looking at this just purely from a covered call perspective, Tim, let's just say, we own, just to look at the 100 shares, 200 shares, let's just say we have we own 100 shares. So you have unlimited potential to the upside. You have unlimited, risk to the downside. Well, limited, but goes to zero. We would never hold a directional, trade through earnings like this. And we wouldn't hold it through, selling the covered call either. So if you sell the covered call here, and we'll get 25 cents for that. So if you sell the covered call, looking at the risk profile again, now what you see on the risk graph, you have, and this is what we talked about, Tim, you have limited potential to the upside. As you can see, the blue line, that's kind of the strike price we're selling at $10. So if it goes above $10, you can't make any more money than the $10. But as you can see, as it comes down here, look at that, unlimited, risk to the downside. So you would never hold that either. The only appropriate thing to do on a stock like the VIPs is to buy the insurance.
While you're on the screen, what's the MMM?
70 cents. Market expects about a 10% price movement.
So, I mean, first of all, that's a pretty good gap, right? 70 cents up or down. Okay. Now, if you go back to the risk profile before you add the put, I want to show this to our audience. Go to the price slices and add 70 and subtract 70. So 970 and 830.
And
so it's always about reward and risk, Matt. And if you get the gap up 1 MMM, you make, and let's put both positions in there for the cover call. If you have the cover call, you only make 37, but you lose 58.
Yeah.
So you have an inverted reward to risk ratio with no extra probability. It's not a good play from a mathematical standpoint. But if you add the put option, like you're going to do, and explain kind of why and how you do that.
The question becomes what time frame to look at, right? Typically, when you're buying options, you want to go out a tremendous amount of time, right? Because you don't want theta to impact the trade. But Tim, we're only covering the risk today. So how much time should we look at typically?
If I'm only covering 1 day of risk, I might only buy like the 11-day option there, quite frankly. I don't need a longer term option. I just want to hedge the gap. If I have this as an investment in a portfolio, I might buy, 3 or 4 months, but that's a completely different conversation. So I would probably do something very, very short term. And actually, there you go. There are different ways you can do it. Doing 2 of them though, that's a pretty costly 9-strike put.
It is. You would probably get off that one. You might look at the 8.5.
Yeah. Those ones are a little bit more.
Okay. And if you do 2 on the 8.5, you kind of create that type of situation where you take out the risk.
Sure. Set the price down on the bottom as a midpoint offer. That 30, I know it's only a nickel, but that cheaper stock. Okay. So this one would make more sense to me, right? Having a couple of short-term put options to hedge the delta risk to the downside. And you're creating that bi-directional type scenario on the gap. Now, Matt, let's say that you're out there and you're brand new and you're like, holy cow, all these steps are confusing the hell out of me. Well, yeah, just get out of the position. Don't hold through earnings, right?
Yeah, if all of these steps are confusing, you shouldn't be in the VIPs in the first place.
Probably. I think there could be a question of whether you should be in the VIPs at all. I know this, as it's been in a downtrend, I have not held a position on it. Guys.
I did cover calls for the first 5 months. Held through earnings here with insurance, kind of what we're talking about. Once the gap down, I got out completely. I just closed out the entire position. And honestly, I'm not looking to get back into the VIPs anytime soon. But I do understand, I do understand though, somebody who's been doing covered calls on the VIPs for a very long time, kind of being stuck in that position. But sometimes it's best just to rip the Band-Aid off and get out of it and put that money towards something that's working. But if you are holding through earnings, it is vitally important that you cover the earnings risk with the VIPs.
Yeah, we're talking about earnings, and obviously one of our stocks on our watch list here, the Tackle 25 VIPS.
Is there any trade on the VIPs for earnings tonight? If you're not doing the covered call, protective put, if you're just looking for it, I mean, the market does expect a 10% price movement. It's a pretty big price movement.
Pull up that implied volatility graph. Let's look at the consistency of the moves. Actually, bring that blue section up. Big drop like you'd expect, fading afterwards. It doesn't really consistently build before that. Take your gray bar and let's go back. Big gap on it last time, but up and then down, gap and then fill.
The stock's too cheap to do anything.
At some point, you have to see something consistency. Whether it gaps a lot or not, or whatever it is, you just can't see randomness. I mean, Matt, look at the gap behavior on this company. Down, but then it settles for a month, right? Up, and then it backfills. I don't have really a lot of interest in trying to find a trade on this when there's too many other easy trades in the market that don't have anything to do with it. You know what I mean?
No, I agree with that. But also we talked about this last week with the Chinese market stocks that are traded in the U.S. they've shown a tremendous weakness, year to date. Bobbitt, Baidu, Vips, these have shown tremendous weakness. And, with what's happening with the emerging markets, I still see these stocks showing weakness. I mean, even with a positive earnings report, is that going to be able to overcome the geopolitical situations with this company right now? And I'm not sure there's an answer to that question. And if there's not an answer to that question, it might be best just to get out of the VIPs, look for something that's trending and trading a little better, more consistent, wait for this emerging market crisis to kind of get away from us.
Yeah, let's move on to Tesla. Obviously, a company we've been talking about a lot, but quite frankly, every news outlet and every organization and every trader talks about Tesla pretty much every day because of what's going on with it, particularly right now. Matt, they're getting sued by their investors. Elon Musk is getting pulled into all of this. Obviously, a lot of people they believe the same thing you do, that it was manipulation, and you're starting to see some of the backlash here. I also read a very interesting report that part of that buyout at 420 might be from Saudi Arabia and their actual fund. So what's your take here as Tesla is evolving and developing in this news story? Is there anything to see here, anything to do here? Is there any play here?
I don't think so. I think it's still very, very news driven. I read the report that the Saudi investment group is looking at a potential buyout at 420. I don't know anybody in their right mind that would think 420 is a good price to buy out Tesla. I don't see that from a fundamental perspective. It's tremendously overvalued at $350, let alone $420. So whether or not, Elon is trying to cover his tracks because of the lawsuits and the SEC poking at his door, I don't know, but I don't believe Saudi's coming in at $70 billion. I mean, they were coming in at $2, $3, $4 billion. To ratch that up to $70 billion, I think that's a far cry. I think Elon's just trying to cover his tracks right now. Could be wrong. Obviously, we're not in that, but the board of directors was kind of taken back by this. They hadn't even talked about it up until this, Elon's tweet. So, I think he's covering his tracks right now with the lawsuits and the SEC. And, if I was Elon, I wish I had an edit button on Twitter because now he's just covering his tracks, really, in my opinion. I could be wrong, but, I said this from the very, very beginning. The moment he sent out that tweet to him, my reaction was, this is market manipulation. And all I see Elon doing is trying to cover his tracks right now by putting all this information out there, and maybe some of it works, maybe some of it doesn't, maybe he gets off his lawsuits. But until I see evidence that Saudi Arabia had funding secured before that tweet went out, I'm going to come back and just say this was the same old market manipulation. And I think it's completely wrong. I see it no different than when any other Wall Street tycoon does it. I see it no different than the people that Elon hates in the short sellers. And to me, it's wrong. And there's nothing that happens after that will change that fact.
It's going to be interesting.
I've lost a lot of respect for Elon Musk in what's happened in the past week.
Yeah, I'm still very empathetic. I'm trying to figure him out.
I'm not going to Mars with him any longer.
I would go to Burning Man with Elon.
I might go to Burning Man, but I'm not going to Mars with Elon.
Well, first of all, I was never going to Mars. I think that whole expedition thing is really fascinating to me. I'm just not interested in that kind of thing. You want to go to the moon, go ahead, enjoy it. You want to go to Mars, go ahead and enjoy it. But that's a conversation for another time. What I find so fascinating about this, Matt, is the guy's a billionaire. Why would he need to manipulate his stock price? Why does he? Pride, vanity, greed, narcissism, ego.
It's definitely narcissism, right? He's playing this game with Wall Street and he wants to win. And it's just that A-type personality. It's not necessarily about the money, Tim. It's about the win.
Yeah.
It's the same thing that we as traders sometimes fall into. It's the same trap. We sometimes want to be right more than we want to make money.
Yeah, it's obviously been wearing on him the last couple of years, seeing the short interest go up and the negative opinions and the critique about his, debt relationship with his company's equity. And
I don't understand why he hates the short sellers so much, Tim, outside of them just giving him a little bit of heartburn and headache. Short sellers have been absolutely crushed from a financial perspective on Tesla. They've been crushed.
They're attacking his worldview, Matt. Everything he believes about what the world is and what his vision is, they're saying, Elon, you're wrong. And I don't know if people can handle that all the time, especially somebody who works so hard to build a company like Tesla. They may not want to hear that, right? And so I think it comes back to some of the ego. And
Listen, I still believe in his message. I still believe in his vision. I still believe what he's doing is a good thing for humanity. I still see him as a visionary. But the more he tries to fight Wall Street, the more he tries to take them on, the more he is becoming like them. And I just don't like that evolution.
Interesting. A couple of different stocks I want to take a peek at. There was one I really like from this week's stock report, Matt, over at Tackle Trading NOV. And by the way, if you are a pro member, go and watch those weekend reports. There was a lot of really good takeaways from all of the different reports. You get a chance to see that one yet, Matt?
Yeah, I watch all the reports on Sunday. It's just part of my weekly weekend routine, getting ready for the market on the week. Like I've said many times regarding these scouting reports, it's a wonderful way to start generating ideas, to start building watch lists. Obviously, sometimes I look at some of those charts. I'm like, that isn't for me. I don't like that consistency, but every trader has a different perspective. This one on National Oil Well, I love this trend. I love this pattern. This is one of my favorite patterns to trade, a breakout on strength, a retracement on weakness, coming back into the breakout point here at 45.30. So as you can see on its earnings, tremendous movement to the upside on its earnings, breaks the previous level of resistance, gets overextended up into the top end of its potential average range, starts to sell off. The sell-off has less volume on the sell-off than the upward movement on its earnings. That's what I mean by it breaking out on strength, retracing on weakness, comes back into the breakout point, slows its momentum at the breakout point. You're sitting on a rising 20-day moving average. You're in that bull zone. All you're waiting for here is the trigger. And the trigger, when we say the trigger is your point of entry into the position. And every trader is going to be a little different in that capacity, Tim, whether they're looking from an intraday breakout or they're using percentage of ATRs above highs. I think from a basic level perspective, 10% of the ATR above the high of the day is a very good potential trigger. And the reason I really like that trigger, Tim, is because at the high of the day traders are programmed to sell the stock at the high of the day. That's why it kind of pulls back intraday. But once it breaks out of that high of the day, the intraday breakout, those day traders who are now programmed to buy it shows tremendous move to the upside. So if you want the day traders on the same time frame as the swing traders, you wait for that to break out of the high of the day. A more aggressive approach, if you want to be aggressive, would be to drop it down into an intraday perspective, 5-minute chart, 15-minute chart, and find an intraday trigger. So for example, at 45.60, you have an old support intraday level here at 45.60. I could definitely see a trader saying, you know what, I'm going to wait till it breaks up above the intraday level and then get in. But I still come back to the conservative way to do things. I think being conservative in the financial markets is always a wise thing to do. I like controlled risk. I like high probability. And so the trigger above the high of the day is the typical one that I wait to do. Now, if you wanted to be a little bit more conservative, you wait for it to trigger above the high of the day, confirm that the price movement is getting back up there, and then the next day you put your order in above that high of the day to add additional probability. So the aggressive approach to me would be to put an order in above the high of the day today. And if it ever triggers above the high of the day today, then you get into the trade. The more conservative way, wait for it to close above that high of the day and then trigger in above the next day's high at 10% of the ATR. Either way you go about it, I love this trend. I love this pattern. And, when you're looking at any potential swing trade, and that's what those scouting reports are, they're basically swing trading watch list is what they are, right? We don't recommend things. We just put out watch list and people can use that information for however they want to use that. But it is primarily a swing trading scouting report. And so from a swing trading perspective, you got your trigger, you got your stop loss, you got your target. Stop losses have to be under support. My favorite one is 50% of the ATR under support. You as the trader have to determine where that support level is. I'm looking at this at 45.25 as a potential support level. But if somebody said, I want to put it underneath 45, I'd be perfectly fine with that. But you got to select a support level you're comfortable selling underneath. So that would put your stop loss at any point underneath $45. your target, like we've discussed in the past, your initial target is always the previous swing high at 49 here on National Oil Well. Secondary target is based on either Fibonacci extensions or based on potential average yield or based on extended trend line targets. So to kind of explain those differences here, Tim, an extended trend line target would be something along these lines. So if we're looking at connecting the resistance levels to the resistance levels, that would be your extended trend line target. So as you can see, as the price starts appreciating, it eventually will hit that extended trend line target. That's a good target from a trend line perspective. From a Fibonacci perspective, you're looking at just simply, and I know you love your Fibonacci's, but from a Fibonacci perspective, you're simply looking at drawing your extension, coming back down to the retracement, and that would be from an extension perspective. My favorite target, though, from a technical perspective, swing trading, is what we call potential average yield. Potential average yield is simply looking at the previous swing lows to the swing highs and understanding that from a potential price perspective. So if you're looking at these being your swing highs and your swing lows, you're looking at a price going from 41 up to 46. That's a $5 target. When you're looking at the previous one, you're looking at 37.50 up to 44. That would be a $6.50 target. So you're talking somewhere in that $5.50 to $6 range, Tim. If we pivot here at 45, you're looking at a potential target right there at 50 to 50.5. I think 50 being a significant hold number, kind of in that zone of that trend line, I would look at $50 being a potential target.
I like it. I like the setup. You know, the thing about a pick list, and I put out one of my videos of the day on YouTube a couple of days ago, and there's 3 different ways that you can find trading candidates. Obviously, your watch list is number one. You know, whether it's the Tackle 25, or in addition to that, you have your watch list for August. You develop it over time. Every trader has a watch list, right? Second one is a pick list, and that's where somebody else finds a pick that you trust and you know how they've done it, and you go in and play it. I love the scouting reports because then I can go through them. And in a pick list, if I can get a good opportunity like on NOV, the way you've described it, there's a lot of different ways you can play it. I went in this morning, Matt, and the credit spreads don't look great, you know, so I was thinking more either long call or debit spread in the option chain. Obviously, you could just play the stock. It's only a $45 stock. I mean,
well, and if you want to take out theta, volatility, all that, take 1-1, you know, just trading the stock is easier than trading the option. Me, I probably look at either the straight call option or a bull call spread.
Yeah, that's kind of where I'm leaning because I like the, you know, creativity in the options market. But NLV, really good pick from this weekend scouting report from Coach Gino. Really love that. Take a look at a couple of different stocks here, Matt. We have to talk about Home Depot because it's the biggest company with earnings tomorrow. And obviously in the morning pre-market, usually when Home Depot reports earnings, it's a reflection that the market takes on consumer spending and building and housing, and it can have an impact. It's that big of a company, not as big as your Apples and all that kind of stuff, but I'll be watching it. Very conservative company. What are we expecting here on Home Depot?
Expecting a 3% price movement on the up or the downside. So you're looking at about a $6 potential range that the market does expect here. So you're talking about a gap range in that. Not a big expected gap range. And you know, unlike the VIX, which can gap 10, 20, 30% on earnings, you know, Home Depot, such an established company, it doesn't look to gap in any capacity. It has a very, very small movement here on its last earnings report, had a very small movement here on 3 earnings ago, very small movement here, 1 earnings ago, very small movement here. So, you know, if you're looking at this, the market expects a 3% gap. You know, I think the 3%, 2%, that's probably where you're looking at.
Yeah.
I do not expect it to gap very much in any capacity. I mean, so when you don't expect it to gap, you can certainly look at something like a short strangle, Tim.
Well, $200 stock, you have to take delivery of that. So sometimes an iron condor can work out on a stock like this. I think short strangle is the play on Home Depot. Obviously, you know, if you build that out, you're expecting a low volatility move. I wouldn't do the 11-day. Personally, I'd probably go out all the way into October or November and sell. October at 67 would probably be perfect there. $175 is a $20 range, Matt. That's 3 market maker move in cushion. And if you get $20 down, you can get up to the 2. The problem is you can't get equidistant here. If you go 220 on the call, you probably need to go 170 on the put. because they don't have a 215 call for that month. You want to be about equal distance there. So $129 credit on $1,900 buying power.
About 6%.
Yeah, you're looking to maybe capture 1 or 2% is all. In no, it's
I'm
not
not going to make
exciting.
the trade personally. I don't like the projected ROI, but I do love the range here, and I don't think that range is at risk on the earnings gap.
Yeah. A couple of stocks I want to take a peek at as well. Obviously, later in the week, we got to look at Walmart. And Thursday is actually when their earnings are. We're going to be talking about this as we go, Matt. But the biggest retailer, in terms of actual revenue on the planet, they still make a lot more money than Amazon does. Amazon's been a lot better performer. It's been one of my stocks I've been watching lately. It bores the heck out of you, but you got to pay attention to it when it has earnings, right?
Oh, I can't stand this company, but they make more money in one day than Amazon makes in a month.
Yeah, they're still a very profitable company, and they're
People fail to realize how big these established retail companies are.
sure.
I mean, you take it from a car perspective, Tim. Tesla, the number one market cap company in the world, and GM produces 1,000 times more cars and 1,000 times more revenue than Tesla could even think about.
Mm-hmm.
Amazon, the number one retail company in the world from a market cap perspective, and it is not close. Walmart, a $150 billion company, Amazon, a $900 billion company, but yet Walmart is so much more profitable than Amazon is. And sometimes we lose sight in that because we get so involved in these trendy stocks that have massive market caps, but that's all based on projection 20, 30 years from now. That's why those stocks are so high in price, is because of the projection that they will eventually become the Walmart, or eventually they will actually produce as much revenue as a GM or a Ford or a Toyota. But the reality is that's based on projections. This is something that is very, very real. Walmart, from a revenue perspective, is still the number one retail company in the world, and they're very, very important to the retail sector.
I agree. We got to come back to this one through the week. Two companies I need some help with here today, Matt. Spotify. We'll go through one good one bad one. Spotify got a good profit on here. Looking at it, thinking about it, I'm believing in the strength, want to let that thing run. I don't know where to set a target on this. Usually we come up with two different targets. First target, second target. 200 seems very natural, and I'm not taking profit at this point. But
200 is natural. 200 is a good target. But Spotify up 2.9%, $5 on the day. The entire world is showing weakness. Spotify is showing strength. You got to love that. And Tim, if 200 is broken, there's nothing above that. Okay. We did a projection based on potential average yield that puts you into that 200 to 210 level. But the reality is, above a breakout of 200 could be significant. You could see Spotify rise fairly aggressively. That's again, 200 being your initial target. But if it does break 200, Tim, I don't think there is a technical target. It's based on momentum.
Here's the thing. I'm looking at that 210 mark, and that's my current number, based on pay expectation and also kind of thinking through the movement. 175 to 210 would be about, what is that, 35 points? Mm-hmm. The last pay range went from 160 to 198 and kind of, 150 to 185 or so. So that's where I'm mentally projecting, is that 210 range for my target. I know that, obviously you want to play into strength. It's easier to manage a profitable trade than it is a losing trade. And so the one that I'm actually really having a harder time with.
Psychologically, though.
Yeah. Yeah, it is true. I mean, it is a psychological thing.
There should be no difference in the two techniques.
Is Google. Yep. And Matt, the reason why Google's hurting me is that volatility is falling. I'm straight long options on this sucker, and it's not going anywhere. So when you're bleeding on time decay and you're down a little bit in your trade, but you have not broken the trend line or any of that, do you ever, and really here's my question, should I turn this into a spread and let it just be more patient to give it some—
Are you directional calls?
Yeah, directional calls on this thing.
You absolutely should sell 0.25 delta calls against it.
Yeah, I'm thinking about that.
I mean, with Spotify, there's no reason. It's showing strength. With Google, it's showing a little bit of weakness. If you're a little concerned because of the volatility and the time decay, then selling those options at a 0.25 delta will offset some of that risk, give you a little bit more time to play with.
I've had such a bad relationship with long calls my entire career. I got to tell you, Because the suckers are so nice when they work out, but it's a low probability trade that you're going to bleed on time decay. There's a reason why the primary core strategies in my system are spreads, right? And
Well,
it's
I
what
think that's
I
for any
love.
professional, though. I mean, and I'm serious. Any professional, any trader worth their weight in salt does spreads more than they do directional.
Yeah.
The bull
Yeah.
call spread is such a better trade than directional calls. The bear put spread is such a better trade than directional puts.
I agree with that. Yeah, interesting. Well, I mean, the thing about it is, what I like to do personally on a daily basis is go through and make a management decision, come up with a plan, journal it, log it, execute that plan, and move on. So this is the one where I'm just sitting here and I'm trying to figure out that plan. I think that you've helped me here, getting that
Well,
25 delta, just convert it to a
really
spread.
not showing weakness here, Tim. I mean,
I'm not getting out. I mean, the
yeah.
debate is not get out or stay in, right? The debate is, do I spread it or stay long call?
How much time do you have?
Yeah. Well, I have 90. Well, what is it? I have the
Are you in
October
November?
options. No,
October?
October
So,
67.
so October, you got 67 days to play with here. Time decay is going to start eating into you pretty aggressively, fairly soon. I think, you still got plenty of time to play with. What option do you have?
And I'm looking at them right now. I have it spread over a couple of different strikes. I have the 1255, which has now moved to where it's slightly out of the money.
You could sell that 1330 contract, Tim.
Mm-hmm.
Capture $1,550 to offset your $4,500 investment per contract.
Sure.
So you're offsetting about 33% of the risk there. That time decay element, you're losing based on that 1255 contract, you're losing $35 a day per contract. By selling that, you're gaining 26. So you're offsetting the theta decay by about 70%, Tim. I think that's a no-brainer. You turn that bad boy into a bull call spread.
You know what's interesting about this whole setup? When I made the entry point on this, it was, let me look it up, 731. Find that candle. And I think we were sitting there talking. It was intraday. It was kind of moving back up intraday. I caught it at the end of the day. I felt comfortable with it. I actually did two trades at the same time, Matt. I did the long call and a bull put. Okay. I've already taken profit on the bull put. The long call is losing money. The stock is up from where I entered and I'm losing.
Up 20 points from where you entered and you're losing. That is the life of a directional call option trader. How many times have we heard this, Tim? I was right on the projection, but I lost money. Well, you lost money because you didn't take time into account and you didn't take volatility into account. That's why you lost money.
Oh, c'est la vie. Just another. There you go, Marquis.
Technically, I don't think you get out of the trade, Tim. I just don't. I think technically it's still solid, but I do think you have to offset some of that theta risk, and that's selling that. I forget what it was. It was 0.26 delta. I think that's probably the best way to go about it.
Yeah, I think so. Converting it into a spread is probably the way I'm going to do it. Appreciate the tip on that. And that is our halftime report for today, Monday, 8/13/2018. Obviously, the dog days of August here, Matt. But back to school time. I saw the picture you put on Facebook, dropping your child back off to school there, a young cat. That's exciting, right? I mean, our kid's going back to school today. I don't know when everybody else is. You're going to have a little bit more peace and quiet in the house?
It's weird. It's always weird that first day to school because Kat, my little baby girl, she's kind of attached to my hip sometimes, and I called her a precious little narcissist, and that's exactly who she is. I mean, even trying to take that picture it was painful. She's getting into that age group where she's getting embarrassed by me posting things online, and so I told her I don't care, and I'm gonna post it online anyway, so she better look cute. No, it's a good time. Go back to school day. And I know to a lot of people on Facebook, they get annoyed at the back to school pictures, but I don't care. It was a cute picture and I'm proud of that little girl. So definitely, but it's always still kind of a sad day, but I'm sitting here in my office. I'm like, I can't hear anything. I mean, what's going on? So maybe I'll get a little bit more work done, but no, it's kind of a sad day. It's always kind of a sad day, but at the same time, you kind of like the peace and quiet as a parent sometimes, you know. But as for the your little girl, obviously going to the same school as mine, so you kind of had that same feeling today. But to all the back to school parents, enjoy the peace of mind that having your kids go back to school actually represents.
See, I don't have any kind of mixed emotions. I've been counting the days down to get these kids out of my house for quite some time now. I love my daughters more than anything, but my God, I needed them to go back to school.
Having peace of mind is not a bad thing, no doubt about that. Hey guys, you've been listening to the Tackle Trading's halftime report. You've been watching, I should be saying. I guess I'm getting ready for the podcast here in a second. Speaking of the Trading Justice podcast, ladies and gentlemen, we have an excellent guest on the podcast today. His name is Javon Wilson. I've known Javon for many, many years now. His story of how he got into trading, how it changed his life, it's inspiring, and I'm looking forward to bringing my good friend Javon Wilson onto the podcast. So make sure you're downloading that later on today. And if you're not a part of Tackle Trading, it's time to get over there to Tackle Trading, becoming a pro member, seeing those scouting reports and all the shows and everything we do for our team over there. Get over there to tackletrading.com, sign up for a pro membership, and become a part of the team. Team Tackle.
Tackle team. Team Tackle.
I think we're changing it. Team
Tackle.
Hashtag Team Tackle.
Team Tackle, Tackle Team. I like it. All right, guys. We'll see you tomorrow.